Hi, my name is Griffin Sheehy, and I'm the portfolio manager here at Willow Creek. Today we're going to start with a high-level overview of where the major market indices ended the quarter and touch on how this affected long-term returns. Then we'll take a look at a chart that helps drive home our philosophy of owning stocks for long-term. Let's dive in.
Let's start off with our first slide here. When we look at these returns, we want to focus on the points that hit our underlying investment philosophy, specifically allocating to a global portfolio of stocks. The US represents about 2/3 of total publicly traded stocks, which means that international and emerging markets make up the other third combined. Global real estate is pulled out by itself because we can think of publicly traded REITs as having characteristics of both stocks and bonds based on the nature of its cash flows. The split there is 3/4 US and 1/4 international. The question then becomes why this all matters. The easy answer is to just say diversification. The more complete answer is to point out why it works. When you look at the quarterly returns for each sub-asset class, you'll notice that they all have differing returns for the exact same period. This helps smooth the ride in the short term because they aren't all perfectly correlated to one another. For example, when US is down and international is up, and vice versa, the effects become dampened in the portfolio as a whole. Keeping this in mind will also help you stay invested during times of high market volatility because stocks as a whole tend to rise in the long term. I want you to keep the general direction of these quarterly figures in mind and how it feels so that you can think back on it for the next slide I'll go over. This next one here shows annualized returns up through 20 years. This is why we hold stocks for the long term. Short-term volatility can feel like a whipsaw when markets go up and down. I completely understand that. But when we zoom out to see how this affects our long-term plan, we find they're still on track with our original goals. Even with that volatility last quarter, we can see that long-term returns are still largely positive. The takeaway here is to not make decisions based on what happens in the short term, especially when the time horizon built into your plan is looking long-term and takes that volatility into account already. Remember this, stocks will be more volatile by their nature because the role they play in the portfolio is to outpace inflation, whereas the role bonds and real estate play is capital preservation and income. This also balances out short-term volatility from stocks. To drive the point home of our philosophy of investing in stocks for the long term, here's a chart from our friends at Dimensional Funds showing annual US stock returns. Market downturns can be quite unsettling. We all agree with that. It can feel reassuring, however, to remember that although annual stock market returns are unpredictable, they do have a long history of positive returns, which is what this chart shows. Up years have occurred much more frequently than down years in the US stock market from 1926 to 2024. About 3/4 of the down years were followed by up years. The most recent example being a 19.8% loss in 2022, followed by a 26.6% gain in 2023. The takeaway here is that the market tends to reward those who can weather the volatility and stick to their long-term plan.
Thank you for joining me, and I hope you found those charts to be insightful and interesting. If you have any questions, please don't hesitate to reach out to me or your advisor, and we'd be happy to help with a deeper conversation. Thank you.